Wealth can be measured in many ways. As it grows, life can quickly become complex, creating the need for more focused planning. Welcome to We're Talking Money with OmniStar Financial Group. OmniStar has been helping clients achieve financial success for more than 20 years in a client-centric and stress-free environment. With a reputation built on a long track record of working with people who want to grow and protect their assets, OmniStar illuminates the blind spots, provides actionable strategies to help you achieve what's most important. This is where you can count on straightforward and unbiased advice from a team of professionals that are passionate about your success.
Hey, it's We're Talking Money Live, the show dedicated to illuminating blind spots in wealth management and financial planning. I'm Phil Clark, and my co-host is Sarah Haynes. Welcome.
Hi, thank you. Another beautiful day in Wilmington.
Come on, this rain, it's really starting to become a bit monotonous.
Yeah, I love rain. I think it's wonderful, and we need it. But dear Lord, at some point we need a little sunshine.
I'm with you. There's nothing better on a Saturday or Sunday, waking up, it's raining, cup of coffee, just relaxing and watching it rain. But that's once in a while when that feels really, really good. When it's happening every day, and it seems like, last year in Wilmington anyway, we had another record year of rainfall. We were way above our rainfall average, and we're starting off 2021 much the same. And I got to tell you, I'm ready for a little consistent sunshine and
beach weather.
Maybe even spring. Maybe I'm ready for spring already. I don't want to think that way because we still have February, March, and really will be somewhat cool in April. But in this rain, I'm with you. I love the rain, and I know we need it, but I am definitely ready for it to move on for a while.
Absolutely. So what are we covering today? I know that everyone's read our marketing. We're talking about taxes, everyone's favorite topic.
Taxes has to be one of the least favored things when it comes to desired subjects, things that people want to talk about or don't want to talk about. In the don't want to talk about column, taxes are at the top every time. And I think a lot of that, Sarah, is not because taxes are so onerous. I think it's because people don't understand what the tax code looks like. It's extremely ambiguous. It's nebulous in a lot of ways. I don't think people understand it. And so when you don't understand something, you tend to fear it. You tend to turn away from it. But don't get me wrong, taxes they're confiscatory. I think we all dislike them. If you pay taxes, you probably don't like it because it feels like it robs your ability to live a little better. But at the end of the day, I really think it's not understanding them that creates this attitude towards the IRS and towards taxes in general. So I hope we can maybe do a little educating today.
We can. I've got faith in us. There's a meme out there right now, and it starts as a taxpayer, and the taxpayer says, okay, so I owe the government. I apologize. The government starts. Government says, you owe me this. The taxpayer says, okay, so what number is that? The government says, that's for you to figure out. And then the person comes back and says, well, what if I get it wrong? And then here comes the government. Well, you go to jail. So they know what you owe them, and then you have to go through this process of figuring it out. And if you do it incorrectly, especially corporations, you're in some pretty big trouble.
Yeah, the IRS doesn't play around when it comes to following the letter of the law. There is lots of courtrooms, if you will, that will have leniency on many of the crimes in this country. There is one agency that I don't want to battle, and that's the IRS, because they don't tend to give a lot.
No.
They
take a little.
They take. Man, do they take. But, I mean, look, the trade-off is we get a country like America. Right now it's in a little bit of disarray, if you will. But overall, that's what our taxes are for, is to give us this great place that we call America. I simply think right now taxes are top of mind because we've got a new president in the White House that is going to potentially, and at least the vibe that's coming out of Washington is we're going to see a pretty major overhaul on taxes. And so before we get into that, we're going to talk a little bit about 2020. But as we go through 2021, if these new tax laws or the proposal by President Biden is passed, if this is passed, then we've got some pretty major tax hikes ahead. Mm-hmm. On the other hand, Sarah, it's hard to deny that we need it unless we're going to pull programs off the table, remove some of our expenses as a country. There's really no way around it.
Oh, no, the hands are tied. And these are not, all of these hikes in taxes, this is not unprecedented, correct? I mean, wouldn't you say this is almost reverting to previous administrations?
Yeah, for the most part, a lot of it is just going back to the pre-Trump administration. It's going back more of what we had through Obama's 2 terms. So I don't think it's certainly not unprecedented. We've seen tax rates higher than what's being proposed. I think the biggest concern with all of these proposals is the timing. Mm-hmm. So our debt is extreme, and so everyone knows we need more revenue, not to cover the debt, but to cover the annual deficit. 2 things there, and I think a lot of people don't understand that we have 2 boxes of money working here. One is the debt. That's the $30 trillion that is climbing every day. And then there's the annual budget, which runs a deficit every 12 months of several hundreds of billions of dollars, actually trillions. Potentially, right now it's in the trillions because of all the stimulus, but that's just going right over to the debt column. But we need about $1 trillion a year to run this country, and our tax base only brings in about $600 billion or maybe $700 billion. So that's a big deficit every 12 months, and that just gets moved over to the balance sheet. Just becomes a liability. So that adds to that $30 trillion of debt. So we've got to do something here, and I think we should be looking at combinations. But Biden's tax proposal, I don't like it, and I think most people that pay tax, they're not going to like it. But we've got to, as a country, either decide that we're going to stop spending so much, we got to produce more, we got to put more people to work so more taxes can be paid. And that would at least make the tax bite not feel so, it wouldn't be as bad because it would be spread among more people paying the tab. But, speaking of that, I saw this great cartoon yesterday. I need to forward this to you.
Wait, you're watching cartoons or it's a meme?
It's sort of a meme, yeah.
Okay.
Actually, it's a little video.
Oh, okay.
And my wife, who is by education, a CPA, she sent this to me, so she found humor in this, and it was really good, and it's called Our Tax System Demonstrated or Illustrated Using Beer.
Oh, my goodness.
Okay, this thing is great, and so I need to send it to you. We should probably play it on one of our shows. We ought to tell Blake to do that. It really is a cool video, and so it's these 10 people. They're all buddies, and they head into the bar, and basically, what happens is they decide to pay their bar tab based on the way our tax system works.
Oh, goodness.
And so, long story short, the first 4, and they show pictures of them, and you can imagine they don't look like high society. The 4 get to drink beer free. They don't have to pay anything when the $100 tab comes. The next 2 pay a small amount, and then a few more pay a little bit. And then the final guy, number 10, his part of the tab was something like $56.
Oh, yeah.
So they all agree they like this. It feels good to everybody. Nobody feels like they're overpaying, even though it's the rate that everyone's paying is quite disparate. So they all agree, hey, we're going to be here every week. We're going to do this every week. And so they start showing up. Well, the bartender comes in and he says, hey, I want to give you guys a discount because you've been such good customers. So your $100 bill, I'm going to start reducing it to $80. And they were all excited. Well, once again, they apply the United States tax code to this. And so, again, the first four don't pay anything to drink. But then number 5 and 6 actually get paid to drink based on the new system because of the way the taxes work. So they get $3.33 to drink. So they're being paid to drink.
They've got a lot of kids.
Yeah, I guess so. And then they get on down the line to the 10th guy, and the 10th guy has only a 10% saving. So he's now paying, or 16%. So he's now paying $46. Well, the interesting part of all of this is not that he has to pay so much more, but here comes this was the irony. Everyone starts complaining. The people that were paying nothing said, wait a minute, that guy just got $10 back. He has to pay $10 less, and we didn't get any of that. And the guys that got paid $3.33 to drink, they were frustrated. They said, wait, why should he get all the benefit? He got the majority of the benefit. Why shouldn't we have it? And so the next week, and here comes the moral of the story, be careful about how much tax you apply to those who can afford to pay more, because they might not show up. And so the next week, he doesn't show up, and when the bill comes, the 9 remaining buddies didn't have enough among them to pay the discounted rate. So just think about that, because that's how our tax system works right now, and it's about to get a little bit worse. And there's nothing wrong with all of us paying a little more if it's going to make us better, but I don't think it should simply enable us to keep making the same mistakes, and that's really where we are. So with that, let me get away from my little rabbit trail there.
It was a story. It was a great story. We'll
pretty cool.
We'll play their video.
I'll send that video to you. It's really, really well done, and a CPA firm did it, so I believe it's pretty accurate. And my wife sent it to me. She's a CPA, so she believes it's accurate. I have to trust all of them, but maybe we'll play that sometime. And Blake's a beer fanatic, so he might enjoy watching it.
He's already watched it.
Oh, he's already seen it. Yeah, I bet he has. I hope he's not the guy that gets $3.33 to drink. I hope he has to pay some.
I don't think he is.
All right, that's good. All right, so let's talk about last year. Just a couple things before we get into this year's proposed.
Proposed,
right?
yes. Anything that we are talking about is proposed. And we did a show way early in 2020 about PPP. And we even said then, these are things that are proposed. There is no, it's not in black and white. There's a lot of gray area. Same thing for Biden's tax plan. There's a lot of gray area. The numbers we speak about are just proposed. Yeah, I can't think of another word that would better describe what's going on.
They're on the drawing board.
They're on the drawing board.
Maybe they become reality, maybe they don't. But here's what you need to know to get ready for tax day. It's not far away. We're talking about just really several weeks now. April 15th, it's going to be on a Thursday this year. And there are some things that you can still do to make your tax bite a little less of a painful situation. So first of all, be ready for April 15th. Now, if you're a company owner, if you own your business, then it's March 15th. If you're just if you don't own a business, you're a single filer or a joint filer, then you've got a little more time. So April 15th. 2 things right out of the gate. The standard deduction moved up to $24,800. It was $24,400 for joint filers, and it's up to $24,800. So a little more of a benefit there. And then it was $12,400 for single filers.
Mm-hmm.
It's moved up to $12,400. So little increases there, going to help. Income tax brackets increased for inflation, but so nothing really major happening there. But let's go back to what you were talking about. You hit one of the subjects right out of the gate, and that's PPP.
Oh, yes. How are we being taxed on PPP? And many small businesses benefited greatly from the PPP loans. I think it was that part of the stimulus, as long as it made it to the right businesses, was a huge benefit to keep people afloat in 2020.
There's no doubt. Some businesses, interestingly enough, when we were combing their P&Ls here at the end of the year with particularly the practices that we work with and non-medical, what we noticed is that they were very close to their 2019 revenues because of PPP, and then some were slightly down. But Sarah, we had some that were beyond 2019 numbers, and 2019 was a really good year for them. So PPP made a difference for businesses, mostly in a really, really positive way. Some not as good as others, to your point. Some that probably needed it more than others. Maybe they didn't get it or didn't get as much. But I know a lot of people that got PPP loans, and it made a significant difference on their P&L. So overall, it was good.
Oh, absolutely. And earlier again in 2020 in a show, we were talking about PPP and taxes. And if it was used for qualified expenses in that show, we said, all right, you use it for qualified expenses, you can't deduct it. However, that game's changed, right, Phil?
That game got changed a lot for medical, for sure. So on the medical side, they were all saying, wait a minute, what the heck? And at least on the medical side, but really in most ways across the board, you don't have to take it as income now. So you still get to deduct the expenses for which it was used, and the loan is forgivable. So heck of a good deal, a total freebie, just like it was intended to be.
Right.
But then there was all of this uncertainty that came with it, as Sarah pointed out. But today it looks like it's going to be free as the government intended. So I think the only negative part of that PPP, Sarah, is that a lot of people that didn't need the money, they received it. Yeah, and I don't know. I don't know how I feel about that. But unfortunately, just like with President Biden now with this new $2 trillion plan, there's a lot of businesses out there that are having record years.
Yes.
And I just don't believe that they need stimulus. There's also people on fixed income, people that have that live that way every day, people that are 85 years old. Maybe they're not going into they don't go out and buy things or whatever. Their income isn't going to change, and so stimulus for them may or may not be necessary. And then you have the people that don't work. Period. Maybe they're 40 or 50 years old, and they just don't work and haven't worked for years, and they're on the system already. They're getting stimulus checks. And I got to tell you, that one really frustrates me. Some people say to me, well, the 85-year-old, they don't really need it either. Well, they will probably handle it better than the one that doesn't work. But really, in retrospect, I don't think any of them need it if it's not changing their lifestyle. And if their lifestyle was set, I think if their lifestyle was set, then it probably doesn't make a big difference to them. But people that are working, that are raising families, those are really the ones that I think should get it, and they need to be below a certain threshold of income. If you're making $300,000, $400,000, $500,000 a year, I know we paid the tax for that money, and I know that rightfully, if you got a check, you rightfully can keep it. But really, I just say to anyone listening, I would say if you make that kind of money and somehow you slip through the cracks and got one, you ought to be ashamed if you kept it. That money should be turned around and sent back to the government. But just because we really don't have it to spend, and if you're blessed to make that kind of money, I don't think that you should take it. That's another one of my digressions, but
that's okay. To sum it up, it's easy come, easy go. We had a client say it recently. Yep. If there were a better way, I would hope that Washington could put it together. I think that obviously everything got pushed out as quickly as possible from Washington. There were a lot of loopholes. Yeah. I don't know many people that got the stimulus, thank the Lord, that were making 300 plus, but I agree. I'm sure there's some that slipped through the cracks.
I know some that were making above 200 that got it. And, I don't know. I don't really see $1,200 to a family that makes that much.
It doesn't matter.
Doesn't really matter, but it took it away from someone else that could have used it maybe.
Agreed.
And so I just don't like the way it was doled. It could have been done. I mean, look, we're the smartest country in the world, so to speak. We are certainly the most technological company. We've got Microsoft. We've got Apple. We've got all these chip manufacturers.
IBM.
IBM, Big Blue. We have more technology, and you're telling me we can't figure this stuff out. I don't know. That's a different show.
It's a different show.
I got to tell you, I think we could do a better job in a lot of ways. But so real quick for 2020, here's a couple of things that I want you to remember. Tax deductibility, things that you can still put on your tax return heading into April 15th of this year. So Sarah just talked about PPP. That one's not going to strike you in a negative way. It's going to be okay if you're a business owner. Charitable deductions. Remember, you could take 100% of your adjusted gross income last year and offset it with charitable deductions. So you didn't have any limits last year. That was a great benefit. And then you had an above-the-line deduction last year of $300. So if you wrote a $300 deduction or charitable contribution last year, don't forget to turn that into your CPA or your tax preparer, even if it's you. Don't forget to put that on the return. That's an above-the-line deduction, which means you don't have to itemize to take that deduction. You get it no matter what, and that's a huge benefit. That's a nice little freebie. Medical deductions, 7.5% of your adjusted gross income. Don't forget about that one. But again, you have to itemize in order to take your medical deductions. So if they're not above that standard deduction of almost $25,000, then you don't get to take them. And frankly, I'm going to say this to everybody listening. I hope that you can't take your 7.5%, because if you can, you're probably dealing with some major health issues. Either you are or your family is. And so as someone who cares about people's health, I'm just going to tell you, I hope you can't do that. I hope that you have to take the standard, and that means that you're probably pretty darn healthy. So think about that for a minute. Business deductions, we've already covered that. Really, there's really not a whole lot there to talk about. The earned income tax credit, don't forget that. If you qualify, you want to make sure that that's on your tax return. The child tax credit. Now, this is going to kick us into some of the Biden talk. Last year you got up to $2,000 per qualified child. This tax credit, again, it's a credit, number one, not a deduction. That really changes the game when it comes to a tax return. That's a dollar for dollar offset. Right. And Sarah, the proposal from President Biden is that number is going to go up
$8,000.
Significant increase. Yes. We're going to go from $2,000 to $8,000.
Oh my, yeah. I mean, there's a lot of, again, more taxes put on the wealthy in the new Biden tax proposal. But if you have children, this benefit is huge. It's a big change too. It's not a small incremental, all right, here's a little bit more help. Here it's, quadrupling what you had last year.
Basically that $2,000 for 2020, that essentially for, say, a married couple filing with household income of, say, $400,000, this basically converts to a $1,400 refund per child. That's what last year's would do. So think about the proposed at $8,000.
Absolutely.
That could be about say $3,200 refund. That's huge. So if you've got several kids, you're going to love that part of the tax plan. But as we always say, there's no such thing as a free lunch. So more to come on that. But it sounds good out of the gate. Unfortunately, there's some more ominous things in that tax plan that could really cost taxpayers across the board some significant amounts of dollars. So we want to pay attention to that. So stimulus checks, real quick, you don't have to file that as income. That stimulus check was basically giving you an early refund. So if you were going to get a refund of $1,200 and you already have a $1,200 stimulus check, chances are you're not going to get a refund. So it doesn't count as taxable income, but it's definitely going to water down the refund.
Absolutely. And ways, we want to also remind you of ways to offset taxes. It's too late for 401k. We hope, we pray, we plan for you that you in 2021 max out your 401k.
You better, because tax rates are going, we're going to tell you why in a few minutes, but
Yeah.
yes, you're going to want to think about that.
But if you didn't, say you've never heard of OmniStar, you haven't joined us for any show, because we say this all the time.
Yeah.
Make sure that you at least max out your traditional IRA, because you have until you file taxes to do that. And you can also put in your Roth IRA up until you file taxes.
You got till April 15th on Roth or on a traditional. And look, if you're in a 401k at work, that does not mean that you are restricted from having an IRA.
Correct.
At the personal level. And your spouse can have an IRA, even if your spouse doesn't work. Understand there's lots of benefits here that might benefit you. So if you're trying to remove earned income from your tax return, or you want to reduce your tax liability, these are things that you need to look at. So IRAs, Roth IRA is not going to help you any on your tax return, but it's a great way to start building wealth that will never be taxed again.
Mm-hmm.
So huge benefits there. But traditional IRAs, spousal IRAs, and you also have the option, if you're self-employed, you could do profit sharing within your 401k. So as Sarah said, too late to do deferrals into a 401k. Got to do that by 12/31. But until tax filing, you have, which is March 15th for you business owners, but you can go ahead with calculations for profit sharing right now and be prepared by March 15th. And if you file an extension, you can take that all the way to September 15th. So
absolutely
huge opportunity if you are in charge of the 401k at the company, or if you're the business owner. Boy, there's a lot that you can do with that. Short of that, don't forget about the traditional things like the IRAs. So those are another option, and definitely things that should not be forgotten.
Absolutely. As we move into the Biden side, the proposals, there's whispers of changes to retirement savings. The details are very murky on it, but the goal is to provide an equal tax treatment in regards to retirement plans despite your income. So keep in mind, there may be changes to retirement accounts such as 401ks with the new proposal.
Sarah, the definition of murky is dark and gloomy, especially due to thick mist.
Yeah, that sounds about right.
Are you saying that President Biden has a plan that's covered in thick mist?
It's pretty dark and gloomy if we're going to take away some good retirement plan benefits. Yes.
I'm really frustrated about that. I got to tell you, having read a lot of the proposed plan, taking away some of those benefits, limiting certain things, potentially losing tax deductibility on that or pre-tax contributions. There's a lot that works against the average person. And no matter who you are, no matter what you earn, if you're willing to save and you can do it in a pre-tax way, to have that stripped away from us,
Mm-hmm.
I just don't think that's in the best interest of people that are trying to preserve enough capital to retire well and avoid having to call on the government to help. You would think that our federal government would be encouraging every amount of savings possible for every person. But I think, to your point a little while ago, Sarah, sometimes we do things and we cast this huge net, and I don't think the consequences are always intended, but they somehow they happen.
It's the outcome.
There's always consequences with these kinds of things. But a little fun there with murky, but hey, it is murky. We don't know what that plan's going to look like. What we do know is the vibe coming out of Washington is we're going to see mostly an undoing of what President Trump did, which means quite a few things. Let's talk about some of those, because the way you plan for 2020 coming into 2021, so preparing for your tax returns in the next few weeks, is going to be a lot more conducive to lower taxes and probably greater refunds the way it's built for last year. Whereas 2021, with the exception of having a lot of kids, you might find it a little more difficult. So let's start talking about some of that.
Absolutely. At the most basic level, individual federal income tax, the top rate increase is going to go from 37 to 39.6. I told Phil earlier, I don't know why they didn't just go to 40. I don't know where this 0.6 came from. I'm sure there's all kinds of statisticians that came up with it. But that's an increase that I believe is more concrete than some of the other implementations of the proposal.
39.6, so that's a pretty high rate. Now, keep in mind, that doesn't include state income tax. Now, if you live in Florida or Nevada or, Tennessee maybe, and who else has no income tax? Alaska maybe? I can't remember. But there's 3 or 4 that doesn't have a state income tax. Florida's probably the most popular, and I believe Tennessee has become very popular. But in that case, it really helps. But if you live in a state with income tax, for example, North Carolina, where we live, you got a pretty healthy addition to that 39.6. If you're in the top rate or top bracket, you could be somewhere on the order of 46, 47% rough. That's a lot, and that's before we consider one of the next things that Biden's going to do that he wants to do, which is add more Social Security tax if your income breaks the threshold of $400,000.
Absolutely.
Today that's limited. Your first 130, 40,000, you stop paying on the Social Security, and now there will be this gap between that and up to 400,000. But if you go over 400, you've never paid Social Security tax on those amounts of earnings, but you're about to if this law is, or if this proposal is passed.
Right, and the goal of that is to fund Social Security because we're underfunded.
You think it's in trouble? You think Social Security's in trouble?
I've been hearing that Social Security's in trouble since I was old enough to have an economics class, so I don't know. I don't know what to tell you. I would say if we do this, there's a much better chance of it having some health, but like your story, that depends on that top guy continuing to pay and pay and pay and stick around.
Yeah, without that, I'm going to just tell you, I love looking at the numbers. I study them on a regular basis, and I can tell you our Social Security is deeply, deeply troubled by being underfunded. We have more and more people claiming the benefits promised are far exceeding the dollars paid into the system. And, Social Security, we talked about this a year ago on our show, and, it was never intended to be a replacement of income. It was intended to be a little bit of a supplement. But back when it started, just around post-World War II, the idea was it was a supplement, and life expectancy was quite short.
Absolutely, right? Much shorter.
Yeah, people live 2 or 3, 4, maybe 5 years on the average in retirement. Today, it's 20 and 30 years. So the system absolutely is being affected by that. And if we don't get it right, then eventually people are going to be told, sorry, there's not enough here. And I think it'll become a graded system. It'll be looked at from the perspective of not who's paid in the most, but who needs it the most. And so, frankly, Sarah, you might not have any Social Security.
Wonderful. Well, they did say too, prior to the boomers, no one was expecting that much of a burden on Social Security. And then the boomers came along, obviously much more of them than their parents, and that put a very a damper on, I would say, Social Security.
Big strain. Well, here's my question for you. You don't have to answer this today, but I'm going to ask you this question. You can, if you want to answer it now, that's great. But I wonder how you'll feel when you reach the age of qualification for Social Security and they tell you there's not enough for you. I wonder how you'll feel when you look back, having worked 30 years and paid into the system. I wonder if you'll say, yeah, well, no big deal, because that's what a lot of millennials say today. They say, well, it's fine. I'm not worried about that. But it's amazing how how their mind changes as they get older, and you start looking back at all the money that you pay into these systems only to be told there's a chance you won't get any of it. It'll feel different, and I just wonder what it'll be like when a lot of you get there, if there's not enough in the system. It's going to be an interesting time to sit back and watch how you respond to that. I can tell you how I'll respond.
Assuming you're around, hobbling around.
Hey, look, don't count me out. I'll be here.
I do think it would probably be the earliest age of being able to receive it. It's 62 now. I think it will definitely go up probably to 70. That's going to go hand in hand with longevity.
Well, I'll only be 85 or 90 when you get there, so don't count me out.
I'm just messing with you. No, I would be very, very, very unhappy.
I'll probably be slobbering all over myself or something, but I'm going to be around. I'm going to be around checking you out on that.
Hey.
I'm going to ask you that question.
All right, well, how about this? There are some long-term care benefits to the buy-in proposal. Long-term care insurance agents are loving it.
Oh, listen,
loving it.
These guys and gals, there's a lot of insurance agents out there, and look, they get paid good commissions to sell this stuff. I'm not a commission guy, but I can tell you this. I like long-term care insurance because, one, I have a mother that's in a long-term care facility. I know exactly what it costs. We have a lot of clients who have been through this with their family members, parents particularly, and some of our clients even are dealing with this very kind of care. So it is expensive, and I think if you don't prepare well, in other words, if your wealth picture is not such that you can self-insure, long-term care is a great alternative as long as you buy it while it's affordable. But these tax credits, I think, are necessary in a lot of ways, and it's a good thing because it's really shifting the responsibility back to the consumer to say, hey, you need to take advantage of this and get your own coverage. And why? It's because the government's not going to be able to fund it the way they do today. There's a lot of people that rely on Medicaid, which is a state-run program, and Medicare, and so which is federal. But all of these programs will not be able to handle the extreme cost that come with this kind of care. And so you've got to do some of the lifting on your own, and I think that's why some of these tax reforms, these credits are coming. But yes, the long-term care insurance agents will love this because I think their payday or paychecks are about to go up.
They will rejoice.
Yeah.
One of the negatives that we see coming down the line or proposed is going to have to do with estate tax. So the proposal is trying to cut that estate tax exemption in half. Right now, it's at $11.58 million.
It's a lot. That's a big exemption. That's per person.
That is per person.
Yeah.
But they're talking about cutting that in half. So that's another drastic change. There's no, we'll work our way into this. It's just lopping it at the knees.
When that new exemption took hold, it changed the game in a huge way. I remember when I started in the financial services profession almost 30 years ago, Sarah, I remember doing estate planning for clients, and the exemption was $600,000.
Wow.
$600,000 per person. And so you had to implement things like credit shelter trust. They're still used today. Not nearly as necessary today, but there are lots of estates that will easily exceed $12 million. You see it in our planning all the time. When you start reaching out to 15, 20, 30 years, wealth grows. And as long as people are living within their means, their wealth picture probably gets better and better. Well, if this thing is only $12 million versus today it's $25 million or $24 million, that is a big, big difference. So this is almost like a guillotine, if you will, just lopping off the legs of whatever's in the way of that blade. And, man, it's going to hurt a lot of people. So we'll see how this one turns out. But I can tell you who else is going to be chomping at the bit on this one. This will be all of the life insurance guys. And frankly, I'm going to include us in that because life insurance is a great tool to create leverage. It's a great tool. Nothing creates as much leverage as life insurance for the low price of a premium. Easy to build that into a plan, and boy, do you get a lot of leverage. And now I think that's going to become more pronounced, certainly more recognized than it was or than it is with the current exemption being up there at almost $12 million.
Right, and the other piece to estate planning that the proposal is trying to rid the U.S. of is the step-up basis, which is another gigantic part of planning. And step-up basis simply is just when you inherit assets, you take on the fair market value at the death of the person from whom you inherited those assets. So in terms of real estate, that could be excessive.
Could be huge. Right now, I mean, you know, Sarah, when we're planning with a client, any of the clients that our firm represents, stepped-up basis is a big part of the planning. If they have assets that are growing in value, that are deeded assets, we always like to see them will those types of assets because of that stepped-up basis. Now, it's not in every situation. Sometimes it's best to go ahead and gift, or it's best to do something with those assets other than let it be willed. But if it's willed to your children or your heirs, they get that stepped-up basis, and that avoids a tremendous amount of capital gain tax. So if you've got land that you're inheriting or property, real estate, that maybe your parents paid $100,000 30 years ago or 40 years ago, and maybe today it could be worth a couple of million dollars.
A lot.
So all of a sudden you've got, if it's worth $2 million when you inherit it and there's no stepped-up basis, you sell it, you could be paying capital gain taxes on, say, $1.9 million. And that, my friends, would cost you close to $400,000. With Biden's proposed plan, could cost you closer to $500,000, $600,000. That's a big tax bite, and most families aren't prepared for that. So that's one that we're going to have to be on the lookout for. If that passes, that's going to create a significant amount of cash flow for the government, but it's going to create tremendous opportunity for planners to help their clients navigate what I think is going to be some pretty interesting and curvy paths that they're going to have to traverse here.
Oh yeah, and that will affect people of any net worth. I mean, you can be you could be in the lowest tax bracket and inherit something, and it's still going to hit you hard.
Look, if you gift it to your children, let's say you decide, gosh, I'm not going to wait on that. I'm just going to go ahead and gift them my home. Well, guess what? They assume your cost basis when you do that. So if you don't know that, pay attention here, because if you gift and you think you're doing your kids a favor, and maybe you think you're doing yourself a favor, the child inherits at your cost basis. So if you paid $100,000 for that land and 20 years later you pass away, but you say, I tricked the government here, I already gave that land to my kids.
Psych.
If it's worth $2 million, still have that 1.9 of capital gain when they sell it. So no way around that one.
No.
And that stepped up basis, that'll be a painful change that will require some in-depth planning.
Definitely. So let's shift focus over to corporations. Obviously, there's going to be a change in the federal income tax rate for them as well. And I think this gets talked about even more so than the individual tax rate. And that's going to be from 21% to 28%. There we go again. Another very large jump in percentages.
I heard someone on a news channel recently, and they said, it's only a 7% increase. But 7% can be significant, depending on what the cash flows of your business look like and depending on the corporate structure. Mm-hmm. That 7% can make a huge, huge difference. So you got to be careful about that. And we're going to have this alternative minimum tax kicking in under a different set of rules. I think that's going to affect businesses more than it's ever affected them. Certainly it's going to affect individuals
correct
more than it's ever affected them. So that's another one that you're going to have to be aware of. There's a lot in this thing. So as we dig into this corporate side, starts off with this 21% to 28%. But now we have lots of rules that are going to be implemented that say, hey, by the way, you can't send anything overseas.
Right.
You can't get around it that way. There will be some incentives if you keep employees here, but if you try to move them around the U.S. infrastructure and get them over the pond, so to speak, don't think you're going to get away with that.
Which is wonderful. I think having penalties associated with that is a good thing, although it is forcing you to pay those taxes or eat the penalty. So for some corporations, it's a lose-lose, paying more taxes. But there are incentives in place now for green energy. So, the Democrats ran on that agenda that green energy this, green energy that. So there are whispers again of incentives for companies to move towards green energy.
It's interesting that you talk about the green energy. I know I think we're rejoining the Paris Accord. That was one of Biden's. That was
executive
one of his,
order, I believe.
Yeah, I think it was an executive order, and that was certainly one of the things that he talked about in his campaigning. But I'm just not sure how much I believe that things like that should be taking precedent over what I believe is much, much bigger problems. We've got some major issues in our country and even globally. I don't know that things like that should be at the forefront. I think they're important, but President Biden just signed that executive order where we closed the pipeline. Well, not everybody likes the pipeline, but it crushed a lot of jobs. And I think it's some of these extreme moves without any thinking. I think those can be very damaging. I would love to see a little more of a pumping of the brakes, and let's slow it down in Washington, and let's start thinking through the decisions being made so that we get a better result and one that is durable, versus just pulling the trigger and thinking, oh, well, this is what we're going to do because it fits our agenda. I really worry about things like that. I think we definitely need a greener planet, but I don't know if, I think, who is it, Senator, was it John, is it John, no, who is it that's over the green initiative? Is it Kerry?
John Kerry? I could not tell you.
I think that's who it is. I'm watching him fly all over the globe, talking to all these countries about the Paris Accord and the Green New Deal and all this stuff. And he's flying around on a jumbo jet that I don't think that's very good for polluting the air or keeping the air clean. But I feel like there's a lot of hypocrisy going on where we say one thing but we do another. I just wish we get together, cross the aisle, and start thinking about the actions that we're taking. And I bet we'd get a better result. And heck, we'd probably find out that we actually like each other and we can get along. But we don't have that right now. So back to taxes. I'm a little concerned about these new payroll taxes.
Oh, yes, payroll taxes. And again, this is going to affect those earning more than $400,000. It's almost as though, I guess, again, statisticians got in the room and said, all right, we're going to look at $400,000, and that is going to be our hard floor. Anything above that, we are taking to town in terms of taxes.
That's really where they draw the line and start saying that's the
top
upper
1%,
crust, right?
I believe it's top 1% of earners in the U.S. make over 400.
And I think there's a lot of people out there that earn that kind of money, but to build systems so that those people are paying the largest amount of the debt and the largest amount in terms of taxes, I don't know if that's a smart play. And the reason I say that is because those people also spend the most and create the majority, I think, are a big, big part of our GDP. Our our gross domestic product makes up 70% of our economy. So goods and services are 70% of our economy. And I think if you are taxing people too much at the higher income levels, you're stripping away their ability to buy goods and services. And depending on where it goes and the kind of programs that it goes into, I don't know. It could be a dangerous game, but I wonder if enough thought has gone into these kinds of moves to really get the right result. But we'll wait and see, huh?
We will wait and see. Speaking of, we will see you next week as we wrap up this show. We are going to be we're sticking to tax, right? It's tax season.
Yes, it is.
And we'll be chatting about our 12 elements of wealth management. And this one's going to be tax.
Going to be talking about the element of tax.
Yes.
And so we started our series with cash flow, very important. In fact, we think it's the most important element. But taxes, if there's a second most important, that could be it. But that's not exactly why we chose it. We chose the tax element because we're in tax season. And so, yes, this theme of tax will go on now for the next several weeks. We'll continue to educate you on tax changes, things that we think you need to be aware of to be better prepared. And we'll talk about why the tax element is so important, and so many things within it can affect you positively if you take advantage of them, negatively if you ignore them. So stay tuned. We'll see you next week. Can't wait to talk more tax. In the meantime, we hope you take good care.
Thanks for joining us on We're Talking Money. Be sure to visit our website, www.omnistarfinancial.com, where you can learn more about how we provide value to our clients. Subscribe to the show and our newsletters, and drop us a line with suggestions for upcoming shows. If you enjoyed today's episode, we'd appreciate a rating on iTunes, or simply tell a friend about the show. This podcast is a publication of OmniStar Financial Group. Any information provided has been prepared from sources believed to be reliable, but its accuracy is not guaranteed, does not represent all available data necessary for making business or investment decisions, and is for informational purposes only, and does not represent or constitute any recommendations. All expressions of opinion reflect that of the authors and are subject to change. If this podcast contains any projections, forecasts, guarantees, and/or predictions of any kind, you're required to ignore the same. OmniStar is not engaged in the practice of law or accounting, and any information in this podcast should not be construed legal or tax advice. Any distributions, use, or copying of this podcast, other than the intended recipients, is unauthorized.